Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today we have Darius Dale and Ira Harris. Darius is the founder and CEO of 42 Macro, an investment research firm that aims to disrupt the financial services industry by democratizing institutional-grade macro risk management frameworks and processes. Prior to founding 42 Macro, Darius was managing director and partner at Hedgeye Risk Management. He was the sector head of macro team and was a core contributor to the firm's economic outlook and associated investment strategies views there. Ira's independent trader, hedge fund manager, global macro consultant, trading foreign currencies, equities, bonds, commodities for over 40 years. He was also CME director from 1997 to 2003 and also a stint most recently. Welcome, gentlemen.
Hey, what's up, Rich? How you doing, man?
Great.
Thanks for having me.
And just thought we'd begin with a discussion on your global macro view of the economy and the financial markets. Darius?
Yeah, absolutely. So again, I appreciate you guys taking time to have me here. I've been a big fan over the years, learned a lot. Even before we get started, I just want to say thank you guys for providing a lot of thought leadership. One thing I try to teach whenever I'm mentoring young analysts or investors, it's to get them to sort of quote unquote respect the x-axis. And what I mean by that is sort of, put yourself in the seat of someone who's managing risks, making decisions in real time when you're looking at time series and trying to understand, hey, the distance between catalyst A and catalyst B, kind of the relationships and time is obviously, as we all know, and you learn the hard way over the course of your year, time is the most critical factor in investing. So I just wanted to say thank you for that before we even kick it off. As it relates to our sort of macro view at 42 Macro, I think you can sort of summarize it through the lens of what I think are the most important cycles to get a handle on from a macro risk management perspective. Growth being one of the most important. We're very much in a growth cycle downturn, and I believe that we believe that it's likely to culminate in what we call an actual recession, as opposed to just a mere technical recession. On the inflation side, it's likely that inflation has peaked from a headline perspective. Although when you look at the balance of risk with respect to core inflation, we're still seeing further upside momentum there that may persist into the early fall. On terms of the liquidity cycle, it's very much that the Fed is likely to be engaged in removing liquidity via tightening policy rates and shrinking its balance sheet for longer than the market is currently pricing. And ultimately, I think that it creates a sort of a series of awkward risks and catalysts for the market throughout this fall and potentially into this winter. And then lastly, we do believe that the profit cycle is very much swung into a negative state with a very likely earnings recession to start to commence here in the back half of the year that may persist for several quarters. So it sounds quite bearish. I don't particularly enjoy being bearish. I think it's a very unnatural state for markets, but I do believe there's a decent amount of risk to be priced in as it relates to the interplay between the divergent liquidity functions and growth function in the economy.
Very, very interesting. And your thoughts, Ira?
Oh, that's I really hadn't known of Darius, and then I saw a podcast he did. I said, "Wow, this is," as I emailed you right away, Richard. This is such a good fit for us because, I mean, I'm kind of sitting here laughing because he covers this territory, and he says it's not natural to be, of course, bearish, and it feels funny, but it is what it is. And then he says that there's a piece out today from. I won't speak for Darius, but from Zoltan covering this ground that, hey, we're shifting here. And for those who are only focused in the typical Wall Street fashion of interest rates, linear curves that just, proceed along a fixed path that makes everybody comfortable, we've we are in a whole different world now, and how long this plays out. And as we talk, I mean, what is going to be the fallout from what Nancy Pelosi has deemed to be so important to head to Taiwan? Because it's going to have economic repercussions. And as Zoltan really talks about, and I know Darius talked about too, when I watched that, you know, through supply chain changes and everything that's going around it, there is probably, as Zoltan says, a structural shift. Now, our job is to make money with the structural shift. I don't care what, you know, what people, you know, you want to tune into. No, our job is to direct you to make money. And, you know, as Louis Gavay has always maintained, I'm not here to forecast for my clients. I'm here to adapt. And I think that's probably where we're going to take off from, in how do we adapt to this possible changing environment.
Yeah. I mean, with respect to adaptation, I think this has been a year of adaptation for investors, right? This is the first time we've seen in a long time the covariance between fixed income securities and equity securities, particularly treasury bonds, you know, have positive correlation. It's the first time we've seen such a significant negative bear market in both at the same time. I want to say going back to like the 1930s. So it's been, you know, in terms of adaptation, you know, a lot of investors, you know, particularly that have been trained, that have had models or entire investment processes trained on the last kind of 20 to 25 years of, you know, data, market data, economic statistics, have really had their worlds turned upside down by this sort of, you know, vicious return of inflation that the Fed looks to be very serious about returning back to target.
What do you make of the geopolitical risk emerging now in Asia, but also in Europe, Darius?
Yeah, no, I mean, so those are two loaded questions. So I'll start with Asia. It seems to be easier at this particular juncture. I mean, I don't think you need a rocket science degree to know that this trip by Speaker Pelosi is ill-timed. Whatever it's hopeful to accomplish, it's probably going to do more harm than good, just given the timing of the trip with respect to you know, President Xi's, you know, so-called coronation in a few months. Is obviously China continues to struggle with zero COVID from the perspective of their economy. You know, the likelihood that they're going to want to show strength abroad amid such a you know, kind of a weak domestic economy is something that we think heightens the risk of seeing some sort of adverse response. Now, are the U.S. and China going to go into war because Speaker Pelosi visits Taipei? Probably not. But are we going to see something that looks like, I don't know, let's call it, you know, incremental supply chain disruptions as a function of maybe increased Chinese patrolling of the Taiwan Strait, et cetera? Yeah, perhaps you could start to see rerouting of global ships and global trade. And, you know, it's not going to be the end of the world. It certainly won't be what we saw as it relates to COVID in terms of impacting supply chains, but it could be just an incremental, you know, kind of an adverse outcome in a series of adverse outcomes, you know, that have obviously contributed to inflation being where it is today, 9.1 on headline, you know, sort of right around 5.1 on core PCE. When you talk about Europe, I think that's a much more loaded question because it requires us to sort of, you know, assume that we know what it is that Russian President Vladimir Putin is actually kind of looking to get out of this this conflict. We all assume he wants to take over Ukraine, and if he can't take over Ukraine, then what sorts of concessions will he be willing to stomach? You know, as it relates to you know, kind of which regions, which territories will he really would like. You know, what's the new price on Russian oil and gas exports, et cetera. I have no idea. I'll be the first person to tell you I have no idea. I think most people should tell you they have no idea unless they're really deeply rooted in Eastern European geopolitics. But the one thing I will say is that we've already seen a supply side shock as a response to fear that Russia may turn off the gas taps later this spring. The EU voted, I want to say last week or 2 weeks ago, to reduce gas consumption broadly by 15%. I mean, that's pretty meaningful. I don't know what that translates to as it relates to production and output, but we know it's moving in the wrong direction at a time where the European economy, you know, we look at leading indicators, PMIs, consumer confidence measures, business confidence measures, is effectively falling off a cliff. So that, in my opinion, is quite worrisome because ultimately it's likely to have a secondary impact upon global supply chains, particularly, again, if the gas flows get cut off. you start to shut down whole sectors and industries as it relates to Europe, or shut them down at the margin rather. That may actually start to weigh on supply chain problems abroad.
Very, very interesting. And your thoughts, Ira?
No, I think those are really good points. And again, the newest cottage industry is one that is trying to guess what Putin's thinking about. It's if you're just coming to the table to think about what he's thinking about, it's way too late. In fact, I was just after I read Zoltan's piece, I went and dusted off one of my favorite books, The Petrostate by Marshall Goldman, from who I believe is probably the best Russian historian. I'm not sure whether he's still alive or not. You know, as I'm getting up there, people are disappearing. But we can't follow this per se. But we have seen that Putin has sanctions too, as well as the U.S. The U.S. is a financial-based sanction, and as Zoltan really pushes out, and I think Darius makes crystal clear, those are commodity-based sanctions. And some work better than others, especially if you're looking for an immediate impact rather than something that's carried out over a longer period. So I can't guess what he wants or what's going to bring him to the table. But when you look at it, you go, you know, this is kind of, I go back to my formative years, so to speak, and I go, it's about time to sit down and talk about things because they've gotten out of hand. And who wants to be the last person to die in Ukraine? It always reminded me to be the last 100 people to die in Vietnam, the last 1,000. For what reason? Are everybody's egos so big here that we can't? How did we get here and how do we end it? But I think the ramifications are very right. And when Darius talks about the consumer sentiment, it's really declining in a very quick fashion here. And it was one of the things I was kind of surprised that Chair Powell didn't talk about more, because we're seeing it in the corporate world, right? We see Walmart. Yes, they may have overstocked. Yes, it may have been a mistake, but we see it too. AT&T with their delinquency rates was phenomenally high. And one thing we know, just like in 2008, people said, well, the credit cards aren't in trouble. Yeah, because people were holding on to their credit cards, and they knew that it took 18. And I talked to a good friend of mine who's a bankruptcy attorney. It would take 18 months to get somebody out of their home. So you're making a decision. I'm never going to keep that home anyway. You make decisions as to what's the most important to you. And I would tell you right now, all you do is have to walk down the street and know that people's cell phones are the critical element, as well as their credit cards. The two, I think, go, no pun intended, hand in hand. And we're starting to see some real problems there. So, I'm not sure how fast it's going to be and who's going to pay attention to what, but there are things, and I think that plays right into what Darius talked about with the confidence numbers, and they're shaky.
Shaky would be an understatement. I mean, you missed numbers, trolling all-time lows here. Conference board measures are obviously dropping like a rock as well, somewhere around 99 on the headline. But I think the most important statistic, when you look at the consumer confidence data points, comes from the spread between the expectations index and the present situation index. Right now we're tracking in I want to say the first percentile of all observations of all time. It's very similar to kind of the yield curve, which is, once you go negative in the spread, you're headed towards recession. It's just a matter of if not, or when, not if. But when you get as deeply negative as this, the only discussion shouldn't be whether or not you go into recession. It should be, okay, how deep is this recession likely to be? What's the kind of damage we're likely to see to consumer spending on the other side of this? So to us, our antenna are very much up as it relates to a recession, not the least of which, again, we have indicators like that. We have the yield curve, and obviously we have a Fed tightening cycle that, in our opinion, looks to be ongoing through, most likely the end of this year.
And speaking of the Fed, big question of the day, especially after last week's activities at the Fed, what do you make of the Fed's statements? And do you think the Fed has pivoted already, or is that something to come? Your thoughts, Darius?
Yeah, no, that to me is the question of asset markets here. So I'll be brief, and then I'll be less brief. So to be blunt, We do not think the Fed is pivot. We do believe that asset markets are overpricing the timing and effectiveness of a Fed pivot, particularly as it relates to what actually they would actually do in a pivot scenario. Kind of unpacking that, there's sort of three things that we anchored on. Or let me start by saying, okay, why is the market responding so positively? I think the Fed did two things that has created such a positive response in asset markets. One, Jay Powell sort of reiterated this concept that their estimate of neutral, which is somewhere around 2.5%. And, just based on the commentary surrounding their willingness to go past neutral, was very kind of dovish in the sense that Powell didn't say they were, very comfortable going way beyond neutral, et cetera. It was more like, we're happy to go, beyond neutral, which in this sort of 9.1% headline CPI world or 7.5%, or sorry, I think we're, 6% sticky CPI world or 7.6 on a 3-month annualized basis, you could argue that neutral is probably a little bit higher, which means the Fed's policy on an effective basis is a little bit more easy than I think they think it is. And the markets are interpreting that by compressing risk premia. I think this removal of forward guidance creates an open-ended scenario whereby, the market can start to anticipate this sort of bad news as good news outcome. I don't think the markets have fully pivoted to that yet because we're still debating a recession, but there's a lot more duality associated with the outlook for monetary policy than there had been throughout the year to date. So that is positive. We have seen risk premium compress. Here's why I don't believe it's sustainable as it relates to that compression of risk premium. There's three things that give us sort of a lot of confidence that, this is a Fed that is likely to be engaged in terms of tightening for longer than consensus expects, and obviously as a function of that, doing more. So the number one thing is the vote for the 75 basis point hike was unanimous, despite the board adding 2 new members, and despite, I want to say, Esther George's dissent last month. So, despite seeing incremental growth slowing, they obviously probably got the GDP report before everyone else did. They were still comfortable having a unanimous vote with the fully staffed FOMC. So that's number one. Number two, Powell was largely dismissive when he was asked about the rising risk of a recession. He's citing the still overheating labor market, which, we all know as market participants to be a very lagging indicator. We can unpack all the metrics we're looking at to confirm how overheated the labor market is. And so at the end of the day, we know that the labor market is the last thing to slow down in the economy, which means the Fed is probably going to be tightening for longer than the actual leading growth dynamics would seem to suggest they should be. And then lastly, the Fed wants growth to slow. They're not going to be surprised by a growth slowdown that they're already calling for and already projecting. And more importantly, if reiterated in the last few meetings, confirming that they actually need it to achieve their inflation mandate, which they continue to view as very important, and their labor mandate to be conditional upon actually achieving price stability. So to summarize, we do believe that the Fed is likely to be tighter for longer, which ultimately means they're going to do more than markets are currently pricing.
Mm-hmm. That's great points. That's Sarah.
Yeah, those are great points. And I want to come back to it because when Powell stated that in an answer to the question of 2.25 to 2.5 being neutral, I had to go back and click and listen to it immediately. And I said, well, this is insanity. Did he really mean it? Well, he did mean it. And so it led to this idea. All we did was compress risk premia, as Darius says. That's exactly what happened, because everybody says, well, if that's, and even Larry Summers, and I'm not always in agreement with Larry Summers, but Summers taking him to task about that is absolutely right. But with words, transitory inflation, when they dropped that, but then they went right to neutral on the concept of interest rates, but they never defined it. We don't know what they don't. So am I to accept the Taylor rule of neutral? Because to me, when I think of interest rates, I think of Taylor, because if I'm trying, to me, an aggressive Fed is at zero real yields. Because if I go out 40 or 50 years, the real yield on the 10-year note is like plus 2%. We haven't seen those levels. I mean, that's your grandfather's world as far as I'm concerned, but that's what so when we speak about neutral, that's what I think about. But I think Darius raises a really good point here on the unanimity of the vote. Because yes, Esther George, which she wanted less in June, which surprised me because she's the real genuine hawk and has been for quite a while. And she was a little worried about what she was seeing coming out of the Kansas City region as far as agriculture. The farmers weren't necessarily doing as well, and there were some issues. So she was a little more reticent. But I was actually thinking we were going to get 2 no's, and that was from Philip Jefferson and Lisa Cook, because these aren't my words, because I don't get political. I'm not here for politics. I'm
here to make money.
Always stress in my blog. My politics, if you know my politics, I've done a bad job of being a financial analyst. But I thought that having read their research, I thought that they would step up here and go, "Now this is a little too quick," because they're both labor economists. And I've never met a labor economist that doesn't err on the side of the jobs mandate. That's the way that they see the world. And I'm not challenging that. And their research is steeped in that. So I'm expecting them. We haven't heard. I know that they're new. It was only their second meeting, and no, Jason Furman called them the most dovish picks, along with Sarah Bloom Raskin. Yeah, he wrote a piece back in April or March talking about it. I go, "Oh, Jason Furman is calling him that. It's just not my research." And of course, Raskin got tossed to the side for some reasons. I was kind of surprised Biden didn't fight harder for her, but I think he was more concerned to have Powell in, because I was kind of surprised Powell would want the job, but he was heavily favored because of his work. Not his work, but his concern about the jobless situation through COVID that won a lot of the Biden administration over to his side, that they thought that was a very important element. So I'm waiting to see if we're going to see these dovish elements. And I would put Lael Brainerd in there. So Powell's going to have, and I wondered why he all of a sudden went to that concept of 2.25, 2.5 as neutral. Maybe there was a little more pushback in that meeting. He got the unanimous vote, but maybe it wasn't quite as smooth as.
Well, I mean, to me, I think this is a new battleground for markets, right? Like, are we going to get to a place? Because if you look at our forecast for inflation over the next few months and the next couple of quarters, we're slightly higher than consensus for Q3 and meaningfully higher than consensus for Q4, i.e. that inflation pressure, particularly through the lens of core inflation pressure, is likely to remain elevated, absent some sort of, significant decline in commodity prices, pricing in a recession or something like that. So if based on our kind of baseline scenario, it's very likely that the Fed is going to have to really entertain this debate coming out of the Larry Summers and Bill Dudleys of the world around, are you guys idiots? 2.5% neutral? They said 2.5% was neutral in Q4 2018 when, after inflation peaked to just under 3%. We're 3 times higher than that. So in today's world, in which Powell has already acknowledged there's a significant supply shocks that are likely to be persistent, whether you look at the structural decline in the labor force participation rate, obviously deglobalization being something that has a tail on it. To me, it seems like the Fed just hasn't gotten around to doing the appropriate work, which they may over this sort of 2-month window between the July FOMC and the September 21st FOMC. Maybe they are going to get around to doing that work and ultimately revise up their estimation of neutral, particularly if inflation stays stickier on a core inflation basis.
Yeah, really good. That's really good point. So yeah, I think that's absolutely right. But everybody keeps talking, and even Zoltan in his piece talks about the inner Volcker. But I don't believe that Volcker could be Volcker had he walked into the situation with the debt overhang. And and that's where I think I haven't really been a fan of the dollar rally here, because it's a global phenomenon. The debt overhang, because again, the Fed made dollars so ubiquitous with zero interest rates that the world was really forced to borrow in dollars. So you'd have to be a fool not to be borrowing in dollars. So we have, for the first time, both public and private debt in emerging markets piled up so high, and a rising dollar with rising interest rates is really a major problem here. We haven't heard much discussion from the Fed. Well, the Fed will say it's not our bailiwick. The dollar is a treasury issue. but it is as far as the debt structure. And, how high can it go? I don't know. But Volcker, if he would have confronted, it was one thing to bring the country to a recession. And I was just really gaining my feet as a trader. I was out of graduate school already 3 years and had been kind of looking for it, but it's a whole different world. That debt load that he had to confront was not nearly as great as this is. And I think that it's going to become an issue for the Fed somewhere, because as Jimmy Bianco always talks about, they'll go until they break something. I think the break threshold is lower than we've ever seen it because of the amount of debt.
100%. I just pulled up the chart while you were speaking, and when you look at private non-financial sector debt outstanding as a ratio to nominal GDP, we were at 78% at year-end 1980. We're at 125% now. So that's a significant leveraging of the economy that in our opinion can't take significantly higher real yields, and more importantly, real yields that persist for an extended period of time, because it's not just the actual shock, it's the rollover, the debt in subsequent months, quarters, et cetera, that actually contribute to an incremental slowdown in economic activity. So if you look at the Eurodollars curve, you look at Fed funds futures, they're pricing kind of a quick pivot in terms of a return to monetary largesse. And the reality is, it's very unlikely the inflation dynamics when you kind of get on board and behave in that quick of a manner to allow the Fed to sort of pivot so quickly, unless, of course, we're seeing a very substantial decline in total employment that ultimately has a significant negative shock to inflation. But we've done a tremendous amount of work on kind of the relationship between inflation, employment, GDP drawdowns, et cetera, just sort of studying the 15 recessions that we've had in the last 100 years. And there's a reasonable correlation between the size of the employment shock and the drawdown we typically see in headline CPI and core PCE, but it's not a particularly tight correlation. So it's not like the Fed has the ability to sort of spin some dial or twist some lever, or knob and get the appropriate exact outcome they want, which is inflation behaves with a very minimal de minimis, kind of negative shock to the total employment. It's very likely they either underdo it on terms of getting inflation back to target, or overdo it in terms of getting employment or increasing the unemployment rate. So I think we're heading into a scenario over the next few quarters where the range of probable outcomes is actually quite wide. And at the end of the day, I think the real choice here is, does the Fed save the bond market, or does the Fed save the stock market? And it's our view that I think this Jay Powell Fed wants to save the bond market, at least for now.
Yeah. So by saving the bond market, what I would ask you, in your eyes, what would you see as his most probable course of action?
Yes, and that's a great question. So in our opinion, I think Jay Powell channeling his inner Volcker is the step he needs to take to save the bond market. If you look at where term premium are, particularly on the 10-year, we're at somewhere between -60 and -40 basis points, which in our opinion is the bond market signaling to the Fed that, hey, you've not yet lost a tremendous amount of credibility. However, it's also a risk that they could be deemed to have lost a tremendous amount of credibility. And you could see a sustained period of dollar weakness, treasury bond weakness, if the market deems that the Fed's resolve to returning inflation back to its 2% target is not something to be trusted, or if at the bare minimum they may decide to take a longer term time horizon to get it back to 2%, which in our opinion, I think the bond market would just interpret that as a positive revision to the inflation target. So in my opinion, there's a lot of risk to the bond market if the Fed is ultimately deemed to be too easy and not committed enough to returning inflation back to target. Obviously, we know if they save the bond market by doing more on the tightening side, then by definition, you have to also accept the fact that they're going to lose the stock market and the economy as a function of that. So I think the Fed's damned if they do, damned if they don't. But if you want to say what has worse or longer term implications for the U.S. economy, the U.S. consumer, the U.S. political cycle, obviously saving the bond market is the better outcome from a structural standpoint. I just don't know if the political cycle is going to allow them to do that.
Wow, that's a great analysis of it. And see, as a trader, and I know you trade and manage money, so I look at the 210, 530. So prior to the 210 was having trouble inverting. It was hanging around zero, while the 530 initially inverted first, which I thought was kind of interesting, but we were still in QE. Now QE's over and actually into quantitative tightening, although it's a lot of, until we see the real numbers at 95 billion a month. Okay. But now the 530 is steepened. I mean, we've had a significant movement, and the 210 inverts a little bit more every day. And I view the 210 as more of an institutional player. The 530s are for people like me, speculators, so we can get a little more volatility created there. But the 210 and its relentlessness here. So Powell can say right now I do, and I think you're right. We have credibility. How far will this go? Because we're through 2006 and 2007's inversion and holding. Yesterday I think we moved back to 20, or I'm sorry, I think on Thursday or Friday, we moved back to 20 negative, and out back to today we're 35, 36. I think last I checked. It's been a while, but that became a ceiling for it. So I think that's your point is really well taken, and we find it in the differentiation of the curves. I know everybody's looking at the 3-month 10-year, but I lived through the Volcker and learned quite a bit, and have scars to prove it as to what. But we went negative 300 basis points, and in fact, if you go to the 3-month, we went to probably on the 3 to 30 year. I think we probably went to negative 600 or 650 basis points.
Wow.
But, that's what people have to. Do you think there is no inner Volcker here? Because you're not going to. If you see that, this system will be in mass liquidation.
Yeah, no. I mean, we're 20 now. No chance we get there. I do have a question for you, Ira.
Yeah.
What do you make of this weird kink in the yield curve? As in, you got the twos up. I'm looking at prices now at 298 on the twos. You got 30s at 294, but then you have this weird kink in the middle of the curve in the belly, or not the belly, but in the 10-year at 265. Like, what's your interpretation of that kind of awkwardly shaped curve?
I think that's where people are going, well, he's going to go further than we think. Now, it was less inverted after the, 48 hours after the comment about neutral, because then the bond market got a little cold feet and going, wait a minute, because you can't have both, as you say. He's got to choose one or the other. So the stock market took it, and I mean, that was a 5-6% rally, but it wasn't only stocks. The precious metals rallied, commodities,
Gold,
which had been
Bitcoin,
everything went up. Everybody read it the same way. There was absolutely a synergy there of assets going, okay, he's not going to be nearly as aggressive as we feared going in. And we're rid of forward guidance, which, thank God. I've never been a fan of forward guidance. I think markets do a much better job. And when you keep markets off balance, I think you do, as a central banker, you do yourself a favor. We get back to that Minsky complacency. And when complacency sets in, risk gets mispriced. And at me, I like to see things priced right. We'll work through it and figure out, rather than, I don't want to be spoon-fed. I want to work at it and find, but I think, I'm not sure, but it's giving them a vote of confidence, which I think Powell likes right now. The 30, we don't know, because how much MBS is going to hit the market? And when you get the MBS, you're going to distort everything out, 15 to 30 years, and the Fed's already complaining about the 20-year not trading enough. And there's not enough, and nobody really wants it. Well, they'd like it, but there's not enough volume there, and lack of volume becomes an expense. So people shy away from it. But it's a good question. I think that right now, and Powell feels pretty good about that it's given him a vote of confidence that he's going to be able to do this successfully and quicker than some people think, that he can squeeze this out. And he told us when he embarked upon this, right? He said, well, we can't do anything about the supply chains. We're helpless. But if there's wealth destruction, there will be demand destruction. And the Fed has been pretty good at right now is delivering that.
Yeah, 100%. I mean, look, the Fed he's absolutely correct. And I thought Jay Powell did a masterful job, particularly in the June FOMC, just sort of outlining, hey, look, we understand that a lot of what's gone on here is supply chain disruptions and supply oriented, and we can't really, our tools are, ineffective to do anything about that, particularly over a short to medium time horizon. However, We do have a U.S. economy that is overly, stimulated, particularly from the lens of fiscal policy, but you can argue monetary policy was a big contributing factor to that as well. And so as a function of that, when you look at the spread between U.S. inflation and rest of world inflation, developed world inflation, we're in the 95th or 96th percentile of data going all the way back to 1970 in terms of that's positive spread. So clearly we've contributed, a lot of our incremental stimulus, which has caused incremental, economic outperformance, has led to incremental inflation. And so it's the Fed's job at the bare minimum to return that spread back to its longer term mean so that you can then say, hey, okay, now the rest of it's supply chain disruptions. But until that occurs, and in particularly until we see the core inflation, the services oriented inflation in the US economy really start to dissipate, because that's really where the Fed can't point to supply chain disruptions, right? That just is what it is. Until we see that dissipate, I just don't think the Fed is going to be able to take its foot off the gas, because again, they're anchoring on the labor market to guide their views on growth. And we know the labor market's the last thing to go.
No, it's again a great point. And the labor market, which they took great comfort in. I've never been a fan of the Phillips curve. I'm going back to the 70s when I was in graduate school. I never was, because they wouldn't tell me what their assumptions were. And if it's domestically based, you could see that the economy was reared in political economics. So you could see that the globe was already starting to change. Nixon had gone to China. The Soviet Union was the Soviet Union. We were starting to see changes. And then, of course, when you get globalization with global capital chasing arbitrage in global labor, especially after with the rise of Deng Xiaoping, and then I would say the fall of the Berlin Wall, the world changes pretty dramatically. And the Fed was able to fool itself because it was being bailed out by that arbitrage. Global wages were suppressing U.S. wages. And again, Posar's piece today covers it, and I think very well. But that was certainly an effect going on. And they were able, and I think the Fed did fool itself for quite a while. But if you believe that deglobalization is taking place now, you are going to have a natural inclination then to higher wages. And if you believe wages are inflationary and sticky inflation that way, we're going to be in this situation for longer than they think. Because
are you kidding? Of course, I'm shocked. And I've learned not to be shocked by markets, but the employment cost index number we got on Friday, it was, I think the markets are obviously being dominated and driven, particularly throughout July and into the early part of this week, by, the rebalancing amongst volatility targeting funds, CTAs, quants are, going from structurally underweight stocks to back to neutral, probably to net positive by the end of this process. Once the fundamentalists like us get back involved and we stop being overwhelmed and from a flows perspective, I think people are going to go back and look at that employment cost number as, oh my God, that is terrifying. We hit 5.5% year over year for private sector wage growth or total compensation in that statistic, which is 300 basis points prior to the pre-COVID trend. And to your point, wages are among the most sticky of economic statistics, and both in terms of their lag to the cycle, but also in terms of their autocorrelation. It's going to be a while before we get that anywhere close to something that looks like we're back towards 2% on their inflation target. So I think the Fed might be fighting ghosts for a while on inflation, particularly again through the lens of the more core inflation dynamics in the economy, core inflation, services inflation, wage inflation, stuff that has a lot less to do with global supply chains.
Yeah, it's a good point, and that's where it lies right now. And then you throw in ESG investing. ESG to me is fine. It's a fine concept in a world of globalization. But if the world is deglobalizing, what do I care about what you think of my inflation? Of my polluting. Well, I'm going to burn coal. If coal is in my best interest and I'm China, that's what I'm going to burn. Why should I? I'm not adhering to anything. So ESG to me, and when Larry Fink and who was it, Adam Posen, when they put those pieces out about deglobalization, I said, well, Larry Fink is being disingenuous because BlackRock is one of the greatest promoters of ESG. But can ESG really exist in a world that's deglobalizing? to me, it's, now we're all going to go out for our own, and there's, whatever agreements you make, whether it's Kyoto or Copenhagen or, or Paris, why should I adhere to them? So I think it's another overhang for the equity markets as to how they're going to deal with this.
Yeah, 100%. Completely agree with you. Yeah, we're in a very trying, challenging time. I mean, I could see, just in terms of, this Fed's resolve, I could ultimately see if, we get back to, 45, 46, even back to the all-time 45, 4,600 on the S&P, even back towards the all-time highs in the next 6-9 months, that's going to tell you that, hey, this is a Federal Reserve that took its foot off the brakes, took its foot off the brakes, and ultimately decided implicitly or explicitly that 2% is no longer an appropriate inflation target in this new world. If, however, we think that this is a Federal Reserve that is very comfortable with maintaining that target, sticking to that target ultimately from a variety of reasons, academically or otherwise, thinks that that is the most appropriate target to maintain, I could easily see us going to 3,200 on the S&P. So this is a very unusual time where the range of probable outcomes on a medium-term risk management horizon are as wide as they've been, perhaps in my entire career. And I've been doing this since 2009. So, take that for what it's worth, listeners.
Oh, no. I think that really sums it up. And maybe we'll get something from Jackson Hole, because it was Jackson Hole in 2020, August of 2020, when Powell presented us with that with the flexible adjustment inflation targeting, right? We're going to run hotter for long. I mean, this is not a mistake why we're here. They did adapt policies. So I'm going to wait to see if he speaks exactly what you're talking about. What's this inflation targeting? Are we adhering to something? If we're not adhering to, because if you go the Rogoff-Reinhardt route, to run 4 to 6% inflation for 4 or 5 years isn't a bad thing, especially when you got a big debt overhang. So we'll get that from them too. So you make a great point, I think.
And just
fine. Either way, we know we're headed for fireworks in September and October. It could be up or down. So I guess you got to stay tuned.
Oh, yeah.
Just a final question. Given all these inflation trends, monetary policy, fiscal policy trends, geopolitical risk factors, where do you see the investment or trading opportunities, Darius, like in terms of asset classes?
Yeah, so I mean, look, at the end of the day, we still think that based on their own guidance, and we could be wrong, that guidance could change and morph over time, but based on the guidance they've outlined, it's very likely that the 2% inflation target is still their guiding light, their North Star. And as long as we're on a path towards that North Star, we have to understand that risk premium are likely widen in risk assets and more than likely to tighten in the long end of the Treasury market as a function of the likely growth slowdown that the Fed, in our opinion, is making deeper and more protracted by staying tighter for longer in this process. So, I think if you look at our asset allocation, our portfolio construction, 42 macro, it's kind of organized across, sort of 4 or 5 themes. The first theme being, long lots of US dollar cash. I think we're around 40% cash. We are at 40% cash, inclusive of our long dollar position. Then we're long Treasury bonds. Then we're, short US and European risk assets. And then we're long a tiny bit of China, a tiny bit of crude oil, just as a sort of, kind of risk, a reflation hedge, if you will, if the Fed is ultimately kind of proves us wrong in our views.
Interesting. And your thoughts, Ira?
There's nothing I'm going to disagree with. I think that's exactly right. And as the Fed believed in flexible inflation targeting, my trading is going to be very flexible. I'm going to watch these yield curves very closely, because I think I'm with Darius. I've learned over years, yield curves are very important, and we have to keep our eye on them as to how this plays out. Because it will be the interest rates that will drive equity price. Right now, there's a relief rally, and that's what I would refer to a relief rally, because right in the short term, we've bought in to the 2.25%, 2.5% neutral, whatever that means, and until we hear from Powell differently, regardless of what Summers or anybody or Dudley has to say, that the market has a little comfort there. And with the dollar coming out, if the dollar were to drop 5 to 10%, I think the equity markets would hold in pretty well, because I think a higher dollar is really tightening global financial conditions in a major way. So any type of relief there would provide relief, I think, just to owning various assets across the board. But we're a long way from there, and that would require certain things going very right. I don't see those yet. We'll have to see, what breaks with Russia, and now we got a new tension spot. So, but I think Darius right. The next September, October, November, and the Fed has always been reticent to raise during an election. Mm-hmm. And we are, after Labor Day, we're in full election mode. So, and Powell has shown himself to be far more political than people thought. Now, is he going to break away going, okay, I've got my second term, and but I think we'll see. And his overall board may be a little bit more dovish by their research work and what they're concerned about. And I'm waiting to see if that pops, but all that same.
The one thing I will say just really quickly is that if that does happen, we have to remember that there is a self-limiting factor to the rally in a scenario where the Fed is deemed to be more dovish without actually delivering dovish outcomes. And what I mean by that is that, equities tend to be very positively correlated to inflation expectations, either through the inflation swaps or 10-year or tips break even. So eventually the Fed is going to be moving in the wrong direction as it relates to inflation expectations. So if you want to keep the equity rally going from whatever, local high it's likely to reach between now and let's call it Jackson Hole, you're going to have to see the Fed really start to guide towards cutting rates or doing QE, which ultimately, in our opinion, is quite a ways away.
Yeah, it's a great point.
Cool.
Well, it's been awesome insight. Yeah, thank you very much, Ira and Darius. Thank you so much, and we'll end it there.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.